very strong set of numbers coming in from CEAT. They've also announced further investment in one of their greenfield facilities in Chennai. So let's discuss that and much more with the management of CEAT. We have Mr. Kumar Subbaiah, the CFO of CEAT, joining us on the show. Mr. Subbaiah, hi, good morning. Thank you for your time. Talk to us about the quarter you've had. Very strong set of numbers. Tell us a little bit about how volume growth shaped up in Q3 across domestic and international markets, and which segments particularly have driven the growth that we've seen.
Yeah, good morning. Thank you. Wishing you and your team a very happy new year.
Likewise, sir.
Very satisfying performance, distinctly superior performance, I would say, on three dimensions. On the top line, grew strongly for last 8 quarters in succession. We have grown in double digits. In the quarter that went by, our overall growth was a little over 20%, largely driven by volumes. Margins moved up by about 50 basis points on a standalone basis, quarter on quarter and year on year, almost about 3%. And from cash generation point of view, also is satisfied. We incurred a CapEx of about 250 crores in Q3, and all of that we could fund it from our own internal accruals. In terms of growth, all three segments, our international business, OEM business, and replacement business, all of them grew strongly in double digits, while replacement was in mid double digits or mid-teens. Both international business as well as OEM grew in excess of 20%. So strong momentum, okay, very satisfying and distinctly superior performance in Q3 is the way I would like to sum it up.
You mentioned opportunities in the international markets. How has the international business done for you?
The international business grew strongly, about close to about 30% in Q3 versus the same period of last year. Order pipeline is strong. Of course, US tariff has some implications on us, though our dependence on US is less than 5%. From other markets, we expect to continue that momentum that we saw in Q3 into Q4.
And Mr. Subbaiah, talk to us about the replacement segment. How has demand been over there, and what has the growth been in that on that front?
So it was growth was about mid-teens, about 14% was the level of growth that we achieved in Q3. One of the reasons as to why replacement witnessed a strong growth in Q3 was also the GST reduction that happened effective late September. So that certainly created a momentum overall in replacement. You are aware that the GST on tires came down from 28 to 18% for most categories. In case of farm tires, it went down from 18% to 5%. I think it has increased the attractiveness in terms of replacing a tire versus going for retrading for some other customers. Even with OEMs, I think they saw a momentum in their own growth, particularly in two-wheelers and lower end passenger car, which had a rub-off effect on tires that we supply to them. So overall, I think a strong quarter as far as replacement was concerned. Across all categories, the growth happened. Of course, for us, we grew higher in passenger car, radial and UV tires. Okay, but the growth was strong in two-wheelers as well as in commercial tires too.
Mr. Subbaiah, if you can take us through some of the segments, how they're growing or the demand coming from. You spoke about the fact that passenger cars and UV have grown well because of the kind of momentum that came in after the GST cuts. How do you see the commercial vehicle segment, truck segment? We saw some kind of slowdown there. Are you seeing some revival there?
No, for us, you are aware, look, we are not a big player as far as truck tires are concerned. So therefore, when we are talking about growth, it is on slightly a lower base relative to other large players in this segment. Okay, we saw a growth of close to about 20% kind of a growth year on year in the commercial sector overall. Truck and bus bias tires degrew, okay, in line with the market. Truck and bus radial tires grew for us. With respect to passenger car, the growth was in excess of 20% in Q3 versus the same period. I think what is gratifying for us is that the focus segments, what we call it as 17-inch and above, which we call it as a premium segment, grew faster than the other segments. So I think GST was certainly a trigger in terms of improving the sentiments in the market. And with respect to two-wheelers, which is our core, there's been a fourth quarter in succession. We have been growing in double digits. So it was in mid-teens, was the level of growth that we had delivered in quarter three. So therefore, there is a continuity with respect to two-wheelers in terms of growth sustaining for a period of 4 quarters. In case of truck and bus, overall and commercial segment growth on a lower base, and passenger car and focused categories we grew strongly.
Mr. Subaya, if you can also give us a sense of how the commodity prices have been during the quarter, and do you see them to remain, benign going forward?
Commodity prices remained stable at a very high level. So therefore, our commodity costs or raw material costs in quarter three was in line with quarter two. But however, the currency depreciation, particularly in the last 2 or 3 months, rupee depreciating from 86, 87 level to almost 91 today, would have some impact going into quarter four and beyond. The crude oil and crude oil derivative prices have remained range bound. So crude as continues to be within the range of $60 to $65. So and therefore that is giving a lot of comfort in terms of a lot of our raw materials depend directly or indirectly with crude. Natural rubber prices have moved up, particularly the international prices have moved up from $1,700 to $1,800. So therefore, going into quarter four, it's possible on overall raw material basket basis, the cost could go up by about 1 to 1.5% sequentially.
Then margins should be under pressure in Q4. I mean, you've been able to get a consolidation margin jump of 300 basis points in Q3. You can see some retracement of margins there.
Now currently we reported on standalone basis 14.1%. Okay, it's a comfortable after a long period of time. We have crossed that 14% margin barrier or a threshold. Okay, we would like to sustain at this level. Increase in raw material prices could have a little bit of impact. We will find ways to mitigate it. I think we'd be happy if we are able to sustain at this level in terms of percentage of margin going into quarter four.
Okay, sounding optimistic there, Mr. Subaya. Thank you for your time today. Good to be chatting with you this morning.
Absolute pleasure. Thank you.
Thank you so much. Viewers, let's